Today we're going to be talking about credit repair, and there are 10 different subjects we're going to really get into depth on, and this is what we're going to be covering. Number one, the cost of bad credit, how the credit bureaus work, how to read a credit report, how to read your credit scores, and the top 10 credit secrets, identity theft, proper care and feeding of credit cards, credit scheduling, fundamentals of do-it-yourself credit repair, and debt settlement. Once you understand these basic concepts, you're going to be able to know much more of what you need to do to manage your credit and get yourself into a position where you don't destroy or fall into the 100-point mistakes that so many people get into. So to begin with, credit repair. What is the cost of bad credit? Bad credit is something that can be extremely damaging to you because it can cost you so much and you don't even know that it's really costing you. For instance, bad credit can cost consumers upwards of $3,000 per year, or if you extend that out, $150,000 of wasted money in a lifetime. Now, I'm going to show you some examples where this can be actually much more if you have credit scores that are going down into the 500s. So, because there's extra charges, there's interest in insurance rates, lower paying jobs, lost opportunities, and this is in addition to the $150,000 that can be lost just from interest rates. On the left side there is a demonstration of what the cost of bad credit is. I apologize for it not being very readable, but let's look at an auto loan, for instance. $20,000 car loan paid over 60 months. You will pay an additional $8,593.30 for that car. Now this is in addition to, this is extra interest that you're going to be wasting based on the fact that you don't have a good enough credit score. We'll talk about what that credit score is in just a moment, but let's look at a home mortgage. $100,000 mortgage paid over 30 years, okay? Now you're going to be paying an additional $130,000 for the same home. Why? Well, you've got an extra 1%, okay? What happens if you had an extra 2%? Okay, some people are getting, you hear those 3% interest rates. That isn't 3%, it's actually 3.75 or 3.85% interest, but it is within the 3% interest range. But what if you had a 4 or 5 or 6% interest on your mortgage? How much extra are you actually paying? Literally thousands of dollars a year extra in interest that is hidden. Because how many times do we sit there and calculate that interest on a day-by-day basis? Well, we don't. And so what we're looking at is actually it's a hidden cost because, okay, you've got a 6% interest. Someday, we keep on saying, someday when I get a really good credit score, then I'm going to go back and refinance, okay? But the problem is there's costs in refinancing. There's the fact that you've got to get your credit repaired. How long is that going to take? Well, it might take 7 years, right, for those things, those negatives to fall off. And somewhere along those 7 years, if you had an extra late payment, okay, that's going to drop your credit scores again, and so you might have to go an additional 7 years past that one time when you had that late payment. Or a collection comes up, something that you never knew about, and it pops back on there and really messes you up. So the challenge is, what can we do to recognize that the cost of bad credit is something that we've got to deal with now rather than later, because it's stealing from our back pocket with interest rates, higher interest rates, not only on a mortgage, but an auto loan or credit cards, personal loans, student loans. But what about also the other hidden costs that are involved in there? There might be late payment charges, over-limit fees, all of these other additional charges that just steal money out of your back pocket. And this is hard-earned money. If you're like everybody else in the world, you work hard for that money, and just letting somebody else take it out of your back pocket doesn't make sense. So let's look at this. I've got a bucket example. Imagine yourself, you've got this big bucket, and you're putting all of your income into the bucket. Your job, your tax return, all of these things go into the bucket. And now you're dipping out of that bucket to pay your bills. Your mortgage, your auto loan, utilities, everything else, running off and having fun, going to the movies, all of that stuff comes out of the top of the bucket. But we find that typically there's more month at the end of your money. Okay? There are some bills that maybe go unpaid. But in addition to that, there's another reason why that bucket doesn't have enough money in it to pay all the bills. In the bottom of the bucket, there's little holes. And we're talking about higher insurance rates, higher interest rates, late fees, penalties, all of these other items that start leaking out of the bottom. And we don't even see it because we're looking at the top. We're looking at what goes in. We're not so much looking at what's coming out in these excessive fees and things. What is the cost in loans? We've got a mortgage loan, we've got an auto, we've got credit cards, we've got insurance, we've got the bank fees and all of this kind of stuff. But let's look at this. This is an example of a person who has a 530 credit score versus someone who has an 830 credit score. And this becomes incredibly, you pick your jaw up off the ground because of how much extra that there is in the cost of these same things. If someone has an 830 credit score and someone has a 530 credit score, what is that difference? Not the total cost, not the cost of what the 830 credit score is paying, but what's the difference in that cost? Now let's take, for example, they've got a $200,000 mortgage. They've got a $50,000 second mortgage. They've got the home property insurance. They've got the $20,000 auto loan and casualty insurance on that auto. Okay, so you've got just 5 different things. We haven't put in any credit cards, personal loans, anything in addition. It's just those 5 different items. What is the difference in cost? And as you can see down there, we've calculated $603,000 difference. That's in addition to the actual cost of paying off those loans. It's a horrendous amount. And so you can begin to see that getting your credit actually deals with so much of your life. It impacts so many areas of your life, your financial life, that it would, and of course that impacts everything else, right? It impacts your relationships, it impacts your ability to retire well, it impacts so many different areas. So this is why we're going to look at this and deal with it in a way that gets you back on track, gets a good credit score, gets you to start saving that money and using that money in a way that's beneficial for your retirement, for your daily life. I mean, it's just basic, okay? But understanding the importance, the incredible importance of getting your credit scores back up if there's been a mistake or if there's been negative information put on your credit report that shouldn't be there. There are additional costs of bad credit. Cost in employment, okay? First of all, let's say that you've got, you're looking for work. Let's back up and say you are actually employed, you've got a really good job, and then your employee goes out and checks your credit report and finds that you've got late payments, you've got collections, you're in a security position. What happens? You now are at risk with the company, not just the credit bureaus, not just lenders. You're actually at risk, high risk for your employer. at which point they are going to ask you to leave because they can't trust you. You are a high risk. Put yourself in their position. You are the one that spins the dial on the bank vault, and you have access to all of that money, and you are in collections, you are behind in your payments, your mortgage is a couple months late. What is the temptation factor here? And so you can see that maybe they have justification what they're doing, but that's going to cost you your job. Okay? How about employers basically want low risk and high ethics and morals. They also, let's look at a new employer is going to maybe pull your credit report. We know that the highway patrol, the police, banks, high security situations, the federal government, the military, all have positions in them where they will pull a credit report to find out what's going on in your financial life, to see whether you are managing your finances correctly or whether you are in jeopardy of a high-risk situation. And that could cost you from even getting a good job. And so your jobs are really lower paying type jobs. They're not going to benefit you very well. So any jobs dealing with money, sensitive information, or enticed by such, they can be lost. You can lose them from the beginning. Right. Other costs of bad credit. Just in fact of losing your freedom. If you don't have the money to go on vacation, you can't go on vacation. If you don't have, there's other opportunities, investment opportunities, not getting loans, credit cards with higher interest rates or not being able to get them at all. There's also insurance costs. We know that the insurance can double, triple, and quadruple, or you can't even get insurance with the better insurance companies because they won't even insure you. It's that basic. So there's lots of loss there. Employment opportunities, loss of cash flow. I mean, basically, you're looking at 700 credit score. Used to be a good score. Not anymore. Now you need 740 to get the best interest rates and 760 to get the best insurance insurance rates. So we're looking at something that what used to be really good. If you have anything less than that, you need to take a serious look at your credit report, find out where the damages are, and correct them. In addition to that, recognize that there's two aspects of credit. The first aspect is what's going on in your past. That's already done. It's something that needs to be corrected so that you can get your scores up. But what's happening in your future or today? How are you paying your bills? What are you doing to manage your credit so that you can increase those credit scores and start saving money, but also start having the opportunities that would have been lost? There are going to be some action items that I want you to take and do as we go through all of this, all of these subjects that we're dealing with. And here I need you to take note of these. If you don't have a worksheet to work with, write them down. But here's what you need to do. Fill out a financial worksheet, especially interest rates and interest paid, because as you look at what it's really costing you, you're going to probably sit there and say, oh my gosh, am I really losing that much money? At which point then we can get you seriously involved in this and start working on getting this credit repaired, managing how you pay your bills, when you pay your bills, in a way that really strengthens your credit scores. We want you in the 800s. At minimum, we want you 760 or above, because then you've got the opportunities, you've got the the best jobs available, you have you have the opportunity to save a lot of money that is going to benefit you and help for your retirement, your investment, everything else that's available. Let's also look at the actual cost your score is costing you. You need to identify with the fact that if you have a 700 credit score, your interest rates are higher. Your credit, your insurance is higher. But if it's 680, or let's say it's down in the 500s, 580, you can recognize that you can probably double or triple any of the costs that are involved in having credit. Look at what is your average interest rate. Okay, if it's above for credit cards, if it's above 7%, then we need to look at how we can reduce those and get those in a position where it's much better for you. Mortgage rates, if they're above 4%, let's look at what your credit report is, what's on your credit report, to find out what can be reduced, removed, corrected, so that you can get those better interest rates. What is the average monthly interest costing you? You know, we add all that interest up and see what it's costing you. It can be a huge portion or a percentage of your income, at which point then we've got some work to do. And what is the total yearly cost of credit for you and your family? You know, your wife has credit also, and the combinations. Is her credit better? Is it worse? You know, the interest rates that she has. There's lots of things that we need to look at and see how to improve that. That's the cost of bad credit. It's a major portion of your life, and unfortunately it has affected your life in so many different areas. So let's look at what we can do next. Are we going to teach you how to do credit repair? You bet. We're going to show you how to do it. Okay. Our next section is the top 10 credit secrets. We're going to get down into the nitty-gritty of credit education and what you need to do to manage your credit today on forward. Because if you don't manage your credit personally, if you don't manage your bill payment history, if you don't manage the kinds of credit that you have and the other credit items that we're going to be discussing, then you're going to be going along and just blissfully stepping in 100-point mistakes, which are going to keep you out of being able to do investments and other opportunities, buying a home, buying a car, any of those things that need credit, that you might need credit for. So there are 5 areas with the credit bureaus that they consider important when scoring. The first one is bill payment history. 35% of your score is based on this. And what does that mean? Well, we're talking about when you pay your bills. Okay, are you paying them on time? Are you paying them before they get reported to the credit bureau, so your balances are actually showing lower? Or are you paying them late and getting hit with a late fee and over limit fees and all that kind of stuff? Okay, the second one is account balances. Account balances account for 30% of your credit score. This is the ratio of your credit limit to your credit balance. How much do you have as far as a balance on your account, and how that relates to your credit score? 30% is what it relates. Okay. Third one is length of time opened. How long have you had your accounts? Have are they just brand new, or you've had them for 7 to 10 years? And if you're going to close an account, which ones do you close? Okay, number 4 is new accounts. As we go through life, every now and then we should, or we may need to open up a new account for some reason. How does that affect your credit score? We're going to talk about that. That's 10%. Types of credit used, banks versus finance companies versus credit bureaus, credit unions versus an auto loan. How does that affect your credit score? And that's 10%. Okay, let's get into paying your bills on time. When do you pay your bills? You're trying to get it just barely in the nick of time, or are you paying it before the due date? Let's look at that a minute. I'm going to relate a story that my parents taught me back when I was just a kid, and he said Wells Fargo was asking for drivers to take the mail on these high mountain passes, which were really kind of treacherous, and they were very narrow. And they would ask the first driver, and he would say, well, yeah, I can take that, and I can go take the team up there, and we'll go as fast as possible. And I can get so close, I can run my wheel right up next to the cliff edge right there, and we'll get the mail through. They talked to the second one. He said, yeah, I'm so good. I'm such a good driver that I can take that team of horses and put the wagon wheel right. Half of the wagon wheel is right on the edge of that cliff. And away they go, and we'll get the mail through. Well, the third one comes along and he says, you know something, I'm a good driver, but I'm going to stay away from that ledge as far as possible. And of course they hired the third one, because there's no need to play this little game of how close can I get to the edge before I fall off. And that's the way we want to talk about late payments. You want to pay it before it will ever give you a late. A late will cost you 100 points, 120 points, and last on there for 7 years. It's not worth it. So, pay your bills way before the deadline, and what we recommend is actually paying it about 2 weeks early. The reason for that is it actually has to do with the second item that we're going to talk about, and that is reducing your credit card balances to 45.91% debt to credit limit ratio. In other words, pay it before it actually gets reported to the credit bureaus. And when it gets reported to the credit bureaus, it will have a lower balance, which means that it could actually increase your credit scores. Now, going back to paying your bills on time, there is a significant point when there is the due date, but there is also the recording date. A lot of people get confused by this or never even heard of it before, but you can pay it on the day that it's due, and it won't be recorded for a day or two later. This is a tactic that the credit card companies and mortgage lenders and other lenders will use to collect a late payment from you. In fact, they make more money from late payments and over-limit fees and other fees from the banks than they ever do from the actual interest collected. Billions and billions and billions of dollars collected because of those late payments. And you know something? It's just not a silly late payment. It's just not $25, $35, $39, $59, okay? It's all of the cost that accumulates over the next 7 years because of that one late. Okay, it's the higher interest rates, it's the higher insurance rates. It can equate to tens of thousands of dollars because of one late. Don't do it. For the rest of your life, avoid it at any cost. Never have a late. Okay. It creates more revenue for the credit card company, and if you look on your statement, you see there that when interest is added, to try and find out when it's actually being reported to the credit bureaus. And I would absolutely pay it before that date. Rule of thumb is about 2 weeks early. Okay, reducing your credit card balances. There is a high debt to credit limit ratio, which means that there's going to be higher risk. The higher the debt to credit limit ratio, the higher the risk. And so you want to stay below 45.91%, or as I tell people, stay below 45%. It's not 50%. You'll hear that in the news, you'll hear it on the internet, you'll hear it all over the place. It's not 50%, it's 45%. Stay below 45% at the very worst case scenario. In other words, for a credit, this is for any revolving credit. Stay below the 45%. That's at minimum. You don't want to be above 15% if you can at all help it. Okay? Pay off your credit cards. This is not a banking system. Please understand, credit cards are not a banking system. This is credit, and it costs you. And that interest rate is eating away at the money that's in your back pocket on a regular, consistent basis. Interest never sleeps. It continues through stormy weather, through good weather, through good health and bad health, whether you have a job or whether you don't have a job, night and day, 24 hours a day, 7 days a week, 52 weeks out of the year, continuously accruing money out of your back pocket. Stay away from it, okay? Pay off your credit cards, pay down your debts, get away from credit as much as possible. Start using cash, start using your own banking system, whatever great investment that you're working with. Start accumulating interest for yourself and putting it on your good side. Start having it be a benefit to you rather than a liability. Reduce installment loan balances below 80%. Now these are mortgages, these are auto loans, these are student loans. It's not quite as bad. You don't have to get below 45% as quickly as possible. They understand it's long term and that you got those long term loans because you had better credit. So, but getting it below 80% will actually increase your credit scores quite dramatically. Okay, it is harder to get an installment loan. They use bigger loans. They're fixed payments for a fixed period of time. So above 80% is just too much debt and doesn't show payment history. So by getting it below the 80%, you're actually showing really good payment history, and that's why that works. Raise your credit limits. How many times have you heard at a bank, oh man, you got too much credit, we can't give you this? That is total baloney. And when they say that you've got too much credit, it usually means that they're referring to your credit score, and that's why your credit score is lower. Could be farther from the truth, okay? Raising your credit limits actually shows that you have better risk ability. Okay, because the credit bureaus are saying no problem. The banks are saying no problem. You are a low risk. You have higher abilities to have more credit limit, and so it's going to be actually increases your credit score. But you need to be proactive with your credit. Okay. Credit score is partially determined by how much credit you actually use. Okay, and so there's in this particular scenario, and what we talked about before, if you had debt up to 15.89%, okay, it's actually the same as 0 to the criteria on when they determine your credit score. So stay below the 15% if at all possible. If you're over 88.78%, it's the same as maxing out a credit card. Don't go there. Pay off your credit cards. If you're over 88%, you're in financial hot water and you're in emergency mode, and I would suggest you look at what you're doing and start getting a second job, cutting expenses, get those credit cards paid down as quickly as possible. You are in jeopardy of losing everything. Don't do it. Never go above 45% and stay below 15%. That's just a rule of thumb that you should always use on your credit card. Get as high a limit as you possibly can. It will actually benefit you. Call the company and ask for a limit increase. Ask for them to remove the fees. Ask for them to lower your interest rates. Those are 3 things that you can do just by calling up the credit card company. Number 5, never close an account. The first question that I ask my clients is this: how long does it take to replace 7 years of good credit history? How long does it take to replace 7 years of good credit history? And they'll look at me with this stunned look on their face and try and calculate it. And I say, well, it's 7 years, right? I mean, it's really simple. 7 years it took you to build that credit history, that good credit history, paying your bills on time. So if you close an account with 7 years of good credit history, what have you just done? You've taken that and just thrown all that good credit history right out the window. Don't close an account. Don't close an account unless you know exactly what you're doing and why you're doing it. Keep the accounts active instead. New accounts with lates could be closed and raise your score if they're brand new. We're talking within the first 2 to 3 years. That's only if you have other accounts with good credit history and you just made a mistake on this one account. Okay? If you have too many accounts, you could close the rarely used account if it doesn't have a lot of history on it, or if you have another account with a lot of good credit history on it. You know, a good rule of thumb is just to give a call and get some good consulting with a good credit repair company. That will help alleviate a lot of these questions about this particular thing. Avoid department store credit cards. They're going to offer a discount. You're going to go in and, oh, we'll give you 10% off if you get a credit card with us. Here's the scenario. This is typical scenario. You go in, you get 10% off. They might even give you 20% off for anything that you purchase. And so you go through and you grab a whole bunch more, and that's exactly what they want, right? Because you get a better discount. And so you grab a whole bunch more and you put it on your credit card, but then you don't pay it off. So now you're accruing interest, but by the end of the month, you don't have the money to pay it, and so you're late. And now that 10% discount you've paid double or triple or quadruple for. Don't do it. Don't be enticed. Don't be tricked into doing that. If you've got one good credit card, you don't need anything else. In fact, I'll show you where that will actually increase your credit scores. Next one, shop smart with no inquiries. You want to avoid excessive inquiries. You get 2 inquiries per year, and they will stay on your credit report for 2 years. Okay? Anything more than that, and you start losing a lot of credit scores. In fact, I've seen up to 137 point drop just because of inquiries. 137 points. They had something like 40 inquiries on their credit report. Avoid it, avoid it, avoid it. You don't need it. You can actually shop with your credit score without ever getting an inquiry on your credit report. Here's how you do it. Before we go into that, there's this myth. Well, it's actually true, but there's reasons why it doesn't work. Do your shopping for loans within 14-day time frame. They say that, and don't go over 5 inquiries, and it will all count as one type of thing. Well, that's true, but only for certain type of credit scoring modules. The credit bureaus have, just like software, have new versions coming out on a regular basis. The old classic scoring module, every single point inquiry counted, and over 2 would start costing you points. The new scoring module, they said, you know, if we group them all together, and within 15-day or 14-day time frame, every inquiry in the same type of inquiry, okay, then that would only count as 1. The problem with that is the creditor has to plug in the type of inquiry that it is. And if they do a different kind of inquiry for every new inquiry that you get, let's say for a mortgage, they don't put an inquiry type in there. Okay, that's 1. They put in a mortgage. That's 2. They put it in as a personal loan. That's 3. They put it in as an investment property. That's 4. And then you have all of these different types of inquiry which cause more problems. You don't have any control of that. Okay, the next one is not everybody's using the classic scoring module. In fact, more companies are using the classic scoring module than the new scoring module because it's cheaper. And so you end up recognizing that too late that every inquiry that you've done has started costing you excessive points and put you out of the game. So how do we deal with it? We teach our clients to go and actually shop for credit by pulling a credit report from MyFICO, get the score, and then take that report to the creditor and say, what can you do? What rate and terms can you give me with this credit score and credit report? They can look through it and say, oh, well, we can do pretty good, this, you know, and then you can take it to the next one and they give you their rate and terms, the next one their rate and terms, and you can start without any inquiries, because even when you pulled it, there's no inquiry on your credit report. And the only time that you're going to get an inquiry is when you actually pick the mortgage company or the auto loan company that you're going to work with, and they will need to pull your credit score that way. But then you've only got one, rather than 5, 10, 15, 20 different inquiries. This is the way to shop for your loans without getting any inquiries on them. Okay, the next one. Never use a finance company. What is a finance company? If you go down the street, kind of look at the banks that you see on the street. And you'll see one, there's Wells Fargo Bank, and then just down the street there's Wells Fargo Finance. And you go, wow, what does that mean? Wells Fargo Bank, Wells Fargo Finance, okay? Household Bank, Household Finance. Chase Bank, Chase Finance. And you start to recognize that there's two different kinds of banks going on here. What makes the difference? And they could be right across the street from each other. If you don't know the difference, you could walk into a finance company and or a finance bank and get a loan from them and start paying 2-3 times what the actual cost that you could be getting in savings from the bank. Bank is tougher to get a loan from. Finance company, easy. Banks have lower interest rates. Finance company, higher. Banks have lower penalties and fees. Finance company, higher penalties and fees. You want to avoid finance companies with everything that you can, okay? Just don't go there, okay? Finance companies are damaging on your credit report from the day that they get put on to the day that we take them off, or you take them off, okay? They're just damaging. Avoid them. You don't want to deal with them. On a 1 to 10 scale, they're a 1. Bank is a 10. And we're talking about, when we talk about banks, we're talking about national banks, not a local bank, a national bank. National bank is going to be a number 10. Local bank is going to be a number 9. Credit bureaus are going to be about a 7. Auto loan, depending upon whether it's a finance company or whether it's a manufacturer, will determine whether it's a 2 or a 9. So you want to get it from a manufacturer such as Toyota Finance or GM, General Motors Credit, there's Ford Credit, you know, so on and so forth. Those are the manufacturers, and they're going to give you good credit. Let's see. You can, if you want to get an auto loan, I would suggest that you go to a bank or a credit bureau to get your financing set up before you ever go to the auto dealership. because unless it's a unless it's a manufacturer. But if you go to just a dealership that's selling different kinds of cars, even pre-used cars, okay, you want to get your financing beforehand, because they will do everything that they can to try and get you on their financing. They'll actually make more money with the financing than they ever will with selling you their car. It's just the way they do business. So avoid that. They're getting you into a finance company. Okay. Number 8, get a mortgage on your credit. Mortgages are harder to qualify for, but they actually give you more points on your credit report. It is a new loan, but it is a loan with no credit history. There is a 100% debt to credit limit ratio. You do have an inquiry, but you do want to pay down your mortgage as quickly as possible, below the 80%, because that can increase your credit scores. So we've got several things going on here. A new mortgage can benefit you in multiple different ways. Recognize that between a rental and a mortgage on your credit report, the mortgage will give you a credit score about 40 points higher than renting. Okay? But when you get your brand new mortgage, that can actually drop your score a little bit because of all those reasons that we indicated. But as you get it paid down, and as you're paying it on a regular basis, paid as agreed, then you're going to see that credit score go back up and actually increase it. 9, use only valuable lenders. This is where we're talking about banks versus finance companies. You want to find something that's reputable nationwide, and this is why a national bank is going to be so much better for you. Okay, there's some not so valuable because they don't show all the information needed on a credit report. Let's take a credit card company, for instance, and I'll use Capital One as a good example. Capital One doesn't show you the credit limit on your account. That means with a brand new Capital One credit card, you actually, if you put $1, if you charge $1 on it, you're over limit until you pay that off. Now, what they do is they put that $1 into the credit. The highest credit used column. And then now if you use $1 again on that credit card, you've maxed out that credit card. But you haven't gone over limit this time. So one of the ways that the people overcome that is that they max out the card and then they pay it all off, and then they never go, then they only use 15% or stay below 45% of the largest amount used. Most other credit card companies, good credit card companies, will always put the credit limit on there, and that way that you don't have that problem, even from the beginning. Another bad one is American Express. They do the same thing, and the reason they do that is that they want to keep your credit scores low so that you have to stay with them because their interest rates are higher. Okay, if that makes sense. All right. Valuable lenders are those that are ethical in their practices and are national or international banks and institutions. So just keep an eye on that. Kind of recognize that you want to go with a national bank rather than a local bank or even a credit bureau. Now weigh that against the rates that they might be able to give you. So if you got really good credit scores, you can go to a bank and get really good interest rates. But if you have so-so credit scores, you might be able to go to a credit bureau and get better interest rates rather than the bank, because the bank won't even look at you. Number 10, account balances. What you want to do is keep almost a 1-to-1 ratio between revolving accounts, credit cards, and installment accounts, mortgage and auto loan kind of thing. When you do this, what that's going to do is limit you on the number of credit cards that you're going to go out and get, right? Because you don't have a lot of auto loans, and you don't have a lot of mortgage loans. You just want to keep those credit cards down. You don't want too many. In fact, combination of both revolving and installment loans, you don't want to have any more than 8. Okay? Maximum. And you will start to see that your credit scores go down if you do have too many accounts. Okay? So keep them down. How many credit cards do you need? You need one national bank. In fact, I think it would be really good right now for you to sit down and write out what it takes to get an 850 credit score. I don't actually have a slide on this, but let's write it down. Okay? Number one, to get an 850 credit score, what is it going to take? Number one, you need to have 1 to 2 national bank credit cards. Period. Okay? 1 to 2 maximum. Okay? You want a very, very, very high limit. Okay? Number 3, very, very low balance. Way below 15% if at all possible. Okay? Just keep them low. Okay? Paid as agreed. On time for 49 years. So now you can begin to see how important each one of these aspects is to getting an 850 credit score. You've got to have low number of cards. If you've got so many cards in your back pocket, start whittling them down. Okay? Get rid of the brand new ones that you just got. You don't need them. Okay? Start paying down the balances. Start hang on to them for the rest of your life. Keep one that's the best one, National Bank card. And as you do these things, you're going to start seeing your credit scores go up. In fact, credit history is so very important that it's the major factor between a 760 and an 850 credit score. You will never, ever, ever get into the 800s if you don't have credit history. So that's going to be very important. Your action item is read the top credit secrets on a regular basis, maybe once a year, just to keep it refreshed in your mind and recognize what you may be doing right or maybe doing wrong. Our next section here is how to repair your credit score. And this is getting, not quite getting down to the nuts and bolts. I want to lay out what it's going to take you to get your credit repaired and give you some options to deal with. So let's look at this quickly. There's a difficulty in correcting the negative information. We've just explained that the credit bureaus want to keep negative information as long as possible. But then there's also additional challenges, like if you've got a question about your credit file and you want to talk with somebody on at the credit bureau, what do? Well, you try and find a phone number. Good luck trying to find a phone number. They will dispute. There's an option to dispute online on the credit bureau's website. Don't do it. Very bad mistake. What you're doing is like writing a statement about a particular negative that you have. It permanently stamps into your credit file that negative information. Avoid it. Don't do it. It won't help you. It's a waste of your time. It actually compounds the problem. Don't dispute online. Okay? But if you try and reach someone by phone, by mail, you'll never hear from the credit bureaus. It's just they don't have time for you. Plain and simple. They've got other things. They're making money other different ways. That doesn't make them any money at all, so they're not going to spend any time doing it. I've heard of someone actually getting through on a telephone and being put on hold for 30, 40 minutes. I actually heard somebody actually got through to someone at the credit bureau. That was one person in about 18 years of history. Okay, so not a good option. So how do we deal with the credit bureaus? Now I'll talk to you about that in a moment. When trying to correct, they were told that the item is verified and they won't even look at it again. So these are some basic challenges. We call them stall tactics. There's others that we'll talk about later. But let's begin by start by repairing your current actions. When you do credit repair, there's two main things that are going on. One, there's history in the past, but what about your future? Okay, what are you doing today to pay your bills on time, paid as agreed, so that nothing ever shows up as negative? Okay. Learn how not to make the credit mistakes. Learn how not to step in the 100-point mistakes, and be in control of your credit history and scores. This is paramount. From day one to day, I'm never going to make another mistake. That's what you should be saying to yourself, and practicing and learning so that you are doing the right thing. Okay. Challenge credit bureaus using the Fair Credit Reporting Act. Now, how do we do that? Well, it's a simple letter called a dispute letter, and there's some basic information we'll put into that. Some personal information, account information, actions you want taken, facts about that particular item, so that they can make that determination and get it removed off your credit report. This letter is sent to the credit bureau's dispute department, and the credit bureaus then send it off to Jamaica, Canada, India, or some other foreign land where it's a whole lot cheaper, and they're only given 7 minutes to verify that information, and then they make a determination of whether it's to remove it, update it, or put it into a remains the same status, which then you get an updated credit report in the mail, and you can see what they've done and recognize that you've still got a lot of work to do. Credit bureaus make billions of dollars each year by selling you and others more and more credit reports. The reason that that's the case is because they keep negative information on your credit file as long as possible, and that just aggravates you, and then you have to go and pull a credit report, pay for a credit report and score to find out where you're actually at. Even with a qualified attorney, it can take up to a full year or more to get negative information on your credit report. However, that's going to be a whole lot faster than anything that you can do. But there are a lot of things that you can do, and we're going to show you those. Qualified attorneys can remove inquiries, collections, repossessions, judgments, lates, tax liens, personal information, and so much more, even bankruptcies. So there are things that can be done that can be a great asset to you. Credit repair versus credit despair. Okay, there's 3 ways that you can do it. You can do it yourself, okay, and you can do it. I want to stress that. There's nothing here that you cannot do, but whether it actually gets any action by the credit bureaus is another question, actually. An attorney can actually put some pressure to bear in a way that you and I cannot. But the second option is use an unqualified credit repair company, and there's lots of those around. We call them scams. There's a huge company just in another city not far from here, where their expertise is in marketing, actually, because what they will do is they will charge you a small fee, $49, $69, $79 a month, and that's 3 different options that they have, and then they will take 18 to 24 months to gain about an average of 40 points. Okay, whereas a qualified attorney can actually increase credit scores an average of 127 points in about 4 to 6 months. So when do you need, the question you need to ask yourself is, when do I need my credit repaired? Can I wait 18 to 24 months and get only 40 points, or do I need it now? Okay, so you've got these 3 different options. You can start to work on this yourself. I would advise that you work on managing your finances, managing your payment history, managing the things that you can do on a regular basis so that you can get that done. And then look at the options that you have as far as credit repair and decide on whether I have time now or whether I can't wait anymore and I just got to get it done. Okay, what to look for in a good credit repair company. First of all, they're going to have qualified attorneys where they only deal with credit law. They're experts at credit law. In today's legal market, everybody's going into niches. Well, I'm not a lawyer, so I don't know all these things, but there's credit law, there's patent law, there's family law, there's all of these different things that they have focused on, and a good attorney or a credit repair company will have credit law attorneys that focus on credit law, so that they know exactly what's going on at any, all the new laws that come into play. The strategies and tactics to use with the credit bureaus, which change on a daily, weekly, monthly basis, and things of that nature. Attorneys who do credit repair and do nothing else. Attorneys who, with believable warranty or guarantee that they're going to actually come and do something for you, not just take your money and that's it. They throw a letter at the credit bureau every now and then. There are a lot of things that can be done, and a lot that can be done to your advantage to benefit you and bless your life. Okay. Number 5, useful credit education is included. This is a credit repair company that knows exactly what you need so that you don't fall on your face again. Okay. Credit education is powerful. That's what we're talking about here. All of this information that we're presenting to you. This is education that once you understand it can be a benefit to you, can be something that will keep you from stepping in 100-point mistakes down the road, and you know how long those mistakes last, right? Repeat after me, 7 to 10 years. And that's a long time. And if you need to start investing now for your retirement, for your family, and opportunities are slipping through your fingers, now is the time to get working on it. Okay, they will have a service which is a free consultation service where you can call up and say, hey, I'm planning on getting this new credit card, should I really do it? And quickly, within a minute or two, they can give you an explanation, and huge free consultation. Number 7, offer free credit analysis before you ever pay any money or sign a contract. A credit analysis is so powerful because now you know exactly where you stand, whether you need credit repair or not, what are your options, and when to get started. Okay? That's what you need to look for in a good credit repair company. All right, action items. Get a free credit analysis from a good credit repair company. Find out what's going on in your credit report. Listen to them and learn as they're reviewing the credit report with you what you're going to be looking for from now on as you pull your own credit reports and see exactly what's going on. Great education. Decide if you can take the time to dispute negatives yourself, or whether you need to do something about it now and maybe pay for the credit repair. I will say this. I'm going to stick my neck out and say that it's going to be extremely beneficial to you to get somebody who knows what credit repair is and how to do it correctly. But you've got to find that right company. And the second thing is, it can save you the cost of credit repair 2, 3, 4 times in the first year alone. And so maybe doing credit repair will be an advantage to you rather than just trying to do it yourself and be frustrated.